Welcome to FM Radio, your go-to podcast for everything in the world of funds management. Whether you're an experienced advisor, a seasoned investor, or just starting your journey, we're here to break down the complexities of funds management, all in a way that makes sense. Each episode, we'll talk to the experts to get their insights on everything from asset allocation to risk management and give you the inside track on how decisions are made. This week, we're lifting ourselves out of the day-to-day and taking an elevated view of the industry. Recently, advisors and fund managers from around Australia and overseas were at the Elston Elevate Conference in Noosa. And despite the fact that it was magnificent beach weather outside, everyone was happy to lock themselves into a room to hear what the experts had to say on a variety of topics. Here to help us unpack the insights and tell us why this conference was such a success is Elston's Head of Advisor Services, Mark Smith. Good morning, Mark, and welcome to the show.
Good afternoon, Pete. Thanks for having us. Looking forward to the chat.
Yeah, now look, I think Elston Elevate might seem like a bit of a distant memory now. Time moves fast at this time of year, but it was only a couple of weeks ago, really, right in the sweet spot of spring. It was a good time to get together and talk about what's been going on. And what did you make of the conference? It was obviously a big hit.
Oh, it was great. It was a really good opportunity to spend some quality time with our clients in a beautiful location, Noosa, in spring. I don't think you can beat it. They do say Queensland beautiful one day, perfect the next. It certainly lived up to that. There was a lot of work behind the scenes to make it happen and bring it to life, though. We actually started planning for Elevate back in January, and we really set out with the objective to have an opportunity to bring together our top clients, to have really good quality discussions, to hear insights from world-class professionals. And look, I think we did a good job for the first hit out. Got some great feedback on board as to how we can improve it. So we're looking to roll it out next year as well. But yeah, all in all, it was a fantastic success.
And Noosa obviously was probably your pick. I think you referred to it, the conferences. What do you call it?
We sort of joke in Queensland, we to Noosa as North Melbourne. Look, it is a popular spot for a lot of people around the country, and rightly so. It's got the climate, the beaches, and just a great spot to relax.
And it was obviously, as we talk about the locations, a draw card, but a lot of work goes into selecting the topics and the speakers for a conference like this, because that's the real draw card for the people coming. Was there any particular presentation? I guess there's probably a number, but was there any one that you would name off the top of your head as being one that stood out on the day?
Yeah, I really liked the session we did, which was active reflections from Australia and abroad. So having the opportunity to hear from Brian Kersmake from GQG, Per LaCour from AllianceBernstein, and also our own Bruce Williams from the Australian Large Companies Strategy within the Elston models. Excellent just hearing all their perspectives and also the similarities, particularly some of the challenges all three managers are facing in the market at the moment, particularly around concentration risk.
Yeah, I thought Brian was really good. He put up with all the usual kind of glitches that happen when you dial someone in from overseas, and he was very, very patient with echoes and things. But once we got past the couple of glitches, he had some really interesting things to talk about. And I thought you could just sort of sense people were sort of leaning forward and really interested in what he had to say. And when he started talking about AI, and I guess all of us, it's flooding the headlines and it's in every channel. Everyone's talking about AI, different takes on what that means. But it is a fascinating topic. And from his perspective, to see how he was talking about it, for me, it was quite a unique kind of view on things and where it's really going and what's really coming out of it today. What was your feeling on that?
Yeah, I agree. You only have to pick up the paper or listen to a podcast, and it's all AI at the moment. And it was really interesting, just the sheer quantum of money that's going into AI. I think we heard sort of from Brian around the current spend, $300 to $400 billion and upwards, towards $1 trillion being spent on CapEx from these companies.
So obviously a lot of work went into planning a conference like this, and I know you tried really hard to get really interesting mix of speakers and presenters on the day. Was there any particular presentation or speaker that stood out to you?
Look, I'm a bit biased. I thought they were all great, but if I had to pick one, I thought the session we ran around active reflections from Australia and abroad, having Brian Kersmake dial in from Florida, from GQG, Per LaCour from AllianceBernstein, and also Bruce Williams from Elston, providing their perspectives on investing in the current markets, dealing with concentration risks across various industries, and just some of the thematics coming through. I thought that was quite interesting, particularly just the commonalities across all three managers, very different strategies, but just some of the challenges that they're all facing and how they sort of manage it.
Yeah, I thought Brian was really good. Obviously he had to dial in. I don't know whether he was past his bedtime or the time zone that he was coming in from, and putting up with the usual glitches of dialing in on Teams. But when he started talking, it really had people sort of leaning forward and really eager to hear what he had to say. And he's talking about AI, which is, I guess everybody talks about it, but he had quite an interesting perspective, I thought, from an investment point of view about what's really happening behind the scenes and where it's really going to go. What did you think of Brian?
I thought it was fantastic, and those insights in particular. If you think about investing, it's really about what earnings are you going to generate from an investment, and if you look at the sheer quantum of money that's gone into AI, I think they were quoting at the time as 300 to 400 billion. It's probably heading north towards $1 trillion of capex spending. But what is the return on that? And that's what they're really drilling into. I think to date it's probably about 30 billion, which from a investment return perspective isn't that great. So it's really sort of the question marks over AI. Are they going to get the return that's been sort of baked into some of these prices? Huge question mark. And potentially it could be a house of cards. I'm not saying it's going to fall over overnight, but as investors, money tends to flow, capital tends to flow towards the returns. And if these returns aren't justified, and if we don't start seeing those returns play out, you may see that capital sort of move out. And I think Brian and also Per sort of made the point that if we do see sort of one of the cards fall, there could be a bit of a rush to the exit. So that is a potential risk for that part of the market. The other point he raised, which I thought was really interesting, is if you compare sort of AI to other tech and particularly software as a service, in terms of adding customers into a SaaS style business, there's no sort of really increase cost to adding new customers on board. Whereas with AI, there's actually a cost because it actually takes a lot of energy to run AI. You're thinking you're buying more chips, you need the energy to run those, so the data warehouses. So there's actually an embedded cost in adding more customers. It was just an interesting perspective I hadn't considered before.
Yeah, we had Brian recorded on the day. We've actually got a little snippet that we might listen to because he talks about that, and I thought that was really interesting as well.
So in terms of the AI opportunity, and in terms of market concentration and sort of the question you posed, one of the things that we've been increasingly concerned with, we're not objecting to the fact that AI might be a transformative technology over the course of the next several years. I think one of the things that have given us a little bit of pause is that people are tending to get a little over their skis, a little overextended in terms of how soon this could be influential over the course of time, and kind of how much actual revenue and returns and profits have actually been made up until this point when it comes to AI and where this is coming from. So if I look at just the aggregate sort of overall revenue that has actually come from AI up until this point, if you exclude all the infrastructure build and the spending and the chips that have been spent on this type of thing over the course of time, the aggregate revenue for AI is somewhere in the neighborhood of $30 billion. Now, for the hundreds of billions of dollars, so almost $500 billion of spending that we've seen over the course of time in cloud infrastructure spending, GPU spending, and things along those lines, it seems pretty meager that we're only getting $30 billion in revenue in the grand scheme of things. If you look at the most successful AI company, at least from a consumer standpoint, you look at OpenAI, they have a 2% conversion rate in terms of their users that are actually paying. So despite the fact that they have multiple hundreds of millions of users globally around the world using their sort of product, only 2% of those folks are actually paying for the product on a regular basis or even monetizing those folks. Now, the interesting thing about OpenAI in particular and just AI in general is that unlike SaaS and unlike software as a service, so to speak, each incremental person that you add in a SaaS business platform or a SaaS revenue model, let's say you're using Adobe or you're using Intuit like a QuickBooks or TurboTax or things along those lines, each incremental person that you add to one of those services doesn't really cost the company a whole lot of money. It's actually more de minimis in the grand scheme of things. A lot of those cash flows fall to the bottom line. The difference being on the AI side of things is that it's incredibly compute intensive. So each user that is using the product, and especially if they're not paying for the product, is creating tremendous amounts of cost in the grand scheme of things, which is why you're seeing such a highly negative sort of cost structure.
Yeah, really interesting to hear Brian talk about what you were mentioning and how different it is to companies like Adobe, where they say I can bring on a new user. Yeah, a lot of that subscription goes to the bottom line. It's
That's
not like they've
right.
got to add extra cost or extra infrastructure, or, but it's completely the inverse for AI.
And as I mentioned, the market tends to the capital will flow where those returns are. So investors, if they don't start seeing that return, may grow impatient.
Yeah, and I think because people are genuinely excited, I mean, we can see AI as the great disruptor. No one's exactly sure where it's going to go because things evolve so quickly, and people are trying to, set up infrastructure investment, and people are trying to change their business model. They're hoping to get some efficiencies, but no one's exactly sure what's going on. But it has, as you said, pumped up the Magnificent Seven quite a lot. That creates a lot of concentration, and with that comes risk. And I think Bruce chipped in as well and related that to the Australian perspective, the concentration risk.
Yeah, it's interesting. Australia has always been maybe it's a relation of our size, being a smaller developed market, but we've always had concentration risks in our index. You go back the last 50 years, it's been very concentrated towards the top 10 businesses, generally across a few number of sectors, whether it's materials, whether it's financials. It's just really been a characteristic. So it's not a very well constructed, diversified index. You are exposed to fewer number of sectors with fewer number of companies, whether it's monopolies or oligopolies within those industries. So very concentrated. And the nature of that index has changed over time too. So in terms of, at the moment, we've got CBA pushing up towards 13% index. But if you go back, it was CSL a couple of years ago, similar. Then prior to that, we've had Telstra, we've had BHP, we've had News Corp over the years. So that has always changed. But really, it's just managing that concentration because it works well on the way up, but it also works the opposite on the way down. You can be exposed as investors. And we're seeing at the moment, benchmark returns. A lot of people aren't questioning what's actually under the hood of that benchmark return and what risk they've taken. Case in point, the last 12 months, 65% of the Australian ASX 100 returns have come from 4 companies. So it's just really concentrated, which can create risks if that does turn, particularly if those returns have been based on momentum or pure multiple expansion and not based on underlying earnings growth.
Yeah, I thought it was terrific to hear from Brian and Perlicor and from Bruce as well, and to hear that, I think even from the advisor's point of view, just to know that there's people who are thinking of it from different perspectives and that there really is that need for active management when you've got all these factors at play. So I thought that was a terrific session. In some ways, it was probably a little bit of a wake up call, just saying, okay, there's this shiny rainbow, but we're just not quite at the pot of gold yet in terms of where AI is going. On the positive side, and it's probably a very different kind of session that happened on the day, which I think a lot of people got a lot out of, was when Andrew McKee actually got up and talked about the whole growth mindset and related it to really the people in the room. Because if you think of where Elston's come from and where Andrew has helped to grow Elston as a business, you don't get there without having, clear idea of what you need to do, where the priorities are, how you get the right strategy in place. I mean, what did you feel? I thought it was actually a very relatable presentation.
I agree, Pete. I think particularly Andrew's articulation of the importance of execution over strategy. We've all heard the saying, I think, was it Peter Drucker, that culture eats strategy for breakfast? I would actually take that further and say execution eats strategy for lunch and dinner because you can have the best strategy in the world, but if you don't execute on it, it's pointless. And so to be able to have that hyper focus on being able to execute, and that's keeping it simple. It's no use having a strategy with 400 points that you don't execute and you end up meandering. So keeping it very simple and having clear and definitive timeframes and goals. And that's one thing we do well here at Elston. We do focus, okay, what is it we're trying to achieve? Let's break that down and let's be very focused about executing. So yeah, definitely I thought he did a good job. And also just remembering, what drives a growth mindset is understanding who your stakeholders are. I think that's very important. It's very easy to forget or just focus on one stakeholder, but we look at everything from a decision matrix, whether it's the client, whether it's the business, whether external fund managers and regulators. So just being able to sort of look at everybody as part of that decision making and make sure that you're making your decisions based on, the best outcome for all stakeholders, not just one. There's one sort of little anecdote I'll share too, and I really loved this when I joined Elston. As part of our induction, Andrew did an exercise and he gave everybody in the room who were going through their induction $20, and I thought, this is great, got $20. Thanks, Andrew. But it was more to sort of remind, and he sort of said, well, just remember, I didn't give you this. Our clients gave you this. Just remember who pays us. So at the end of the day, we're here to service our clients and just have that real client focus. And I was very disappointed when he asked for the $20 but he made a really good point about just remembering that, ultimately, we come to work every day, but there's a client at the end, and that client who's paying us to deliver a great outcome.
Yeah, I think the other thing that Andrew made a point about, but which I really related to, I love the way that when Elston talks about the flywheel effect, the need to reinvest in the business and how important that is, and he actually put a number on how much of potential profit Elston will say we need to put that back into the business, which is a real wake up call, because a lot of businesses would go, well, that's a brave move, and from Andrew's point of view, it's a smart move. He actually talked a little bit about that, so we might just listen to this small snippet here of Andrew.
It's great to have a growth mindset, but it's important when you're talking around growth that you communicate the benefits to all stakeholders. What happens if you don't do that? Well, a simple example, when it comes to your team, when it comes to saying growth, 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 all they will hear is work, work, work. So it's all right for you as a business owner to push for growth, but they need to clearly see what's in it for them. The other thing I'd like to point out is that growth is built on a very important foundation, and that foundation is reinvesting in the business. At Elston, we've reinvested an average of 70% back in the business. So don't rip it all out and go buy a boat. Well, okay, maybe a small boat, a tinny or something.
It's a big number. I mean, 70%, I think a lot of people might have been rocking back on their heels when he said that he put 70% back into the business. And he puts it back into the business in a really smart way too, because he puts it back into getting the right people, getting better people, growing the team, but also new services, things like, marketing at Elston and philanthropy. They're the things that he goes, well, that's really what's going to grow the business long term. And they're prepared to back themselves and say, we're going to put that money back in. But that would have probably been surprising to some of the advisors there, I would have thought.
Absolutely. It's really, I think he talks to around, particularly the flywheel. It's about, well, as you grow, you can also, lower costs. That's one option, but also add value. So you touched on philanthropy as a great case in point. But even looking at sort of how do we add more value to our existing clients? I think one thing I've sort of seen, having been at Elston here for close to 10 years, is just the long-term view of being able to front-run growth as well. A lot of businesses wait till they're bursting and breaking at the seams and then sort of add team members. And so I think the ability to actually, think ahead and go strategically, we need somebody in 2 or 3 years' time. We're not going to wait 2 or 3 years. Let's put them on now. And having the confidence to invest in that growth, I think it's, a real credit to Andrew and the business.
Yeah, to be that much more proactive, as you said, not to wait until you need to make a move, but actually get ahead of it and, see where the trends are. And the other thing you have to get ahead of as well, and a lot of people were nodding, I thought, when he started talking about staff and attracting good staff and staff retention, which I think is just a universal problem. I think everybody in the room went, that's a really hard thing to do. If you've got any clues on how to do that, please share it with me. And he was very open and very happy to share, look, this is what we do. We've created a career pathway, but we've also thought about, a reward system, which I think is quite unique.
Yeah, Andrew's, he's done a great job, and all of the business has. I mean, they've had a few sort of fails there. I mean, we obviously snuck through the system somehow, Pete. It's not perfect, but all in all, but it's really about sort of, again, creating that sort of long-term view for the team in terms of their personal growth and their professional growth as well. So we do a lot of work around that, and even being able to share in the upside and the growth of the business. We've got some fantastic sort of incentives around our DEEP, or our deferred employee entitlement plan, to sort of align sort of growth and share that sort of growth with the team members. And that's really something that they've thought about strategically when they set Elston up, is how do we sort of make sure that outside of purely being an equity owner, how can the team members sort of participate in the growth and success of Elston? So, full credit to them for having that, I guess, foresight to sort of implement that at the very beginning.
Yeah, so it was a good session, and I thought it was sort of inspiring. It wasn't heavy, but it was actually some really good practical takeaways. I could see people in the room, their minds were ticking over and going, I could probably implement some of these things in my own business, and that's really what the conference is about. Now, of course, what happens at any of these events is everybody goes off at lunchtime and they have a bit of a feed and have a bit of a drink and have a bit of a relax. When they come back, that's when I always think that's the tricky spot, because everyone's full of good food and they're
Full of carbs.
full of carbs that they're trying to
Keep your eyes
digest,
open.
and they're feeling a bit sluggish, keen to have a nana nap. So to snap us out of that, Brett Luthwaite from Macquarie delivered a wake-up call for us all. I thought it was a wake-up call. What did you think?
Yeah, I've known Brett for over 20 years, so I have seen him present before. He's one of my favourite presenters because he definitely calls it as he sees it. He's not afraid of telling you his views, and that's what you want from an active manager. So in terms of leading with a fixed income discussion after lunch, it was probably a bold choice, but knowing sort of Brett, he certainly delivered there, and it was really interesting some of the points he sort of raised too. Just particularly.
Yeah, we might listen to and see what Brett had to say. We did capture a bit of this, and I think it sort of sets the scene for, as we said, Brett getting a bit of a wake up call.
So let's get into it. And the first thing I wanted to talk about today too is just always thinking about knowing where we're going. You look back to where we've come from, and just like to remind everyone that until a few years ago, this was the incredible world we're in. We spent years and years and years at zero rates, and then this thing called quantitative easing, or this abundant liquidity, when most people don't even know what a central bank is. But you look at the amount of liquidity that was poured into the system, it was an incredible environment to be in. And this concept of beyond the chase is because ultimately this environment led to an incredible chase for yield. It was everywhere in everything. My favorite thing is the NFTs, the Bored Apes, that were trading at all sorts of different amounts. Mine's got gold fur, yours has got brown fur, therefore mine's worth $50,000 more. Like, come on, what are we talking about here? But the reality is that led to a proliferation of trends, and the most popular one was the private trend. I'm in private, you're in private, we're all in private. Ultimately, because we needed yield and we were chasing yield. Okay, that was where we were. Today, it's very, very different. So there's a lot of noise at the moment. We have a very loud US administration, and people are caught up in the left, the right, and all these sorts of things. But I think underneath the covers, what realistically is occurring here is there is appreciation that the world that used to endorse globalization, which ultimately was empowering individual companies to utilize the globe's resources and low-cost locations to maximize profit for themselves, and not necessarily think about whether that's good for individual nations or not, is now behind us. And what we now see is a significant shift to countries realizing if we stayed on that path, the global order was going to change, if it isn't already in the process of changing. And that is ultimately China rising up, being the lowest cost producer with the most incredible $1 billion of oppressed cheap labor, essentially producing just about everything. I think the US realized if it wasn't going to change things and start ensuring it had secure supply lines, that ultimately it would surrender its place in the global pecking order. And it has no real interest in doing that. And so whilst there's lots of noise, what you're really seeing now is one country in particular being the United States, but because of them, everybody else is being forced to do the same thing, is a much greater focus on national interests, as I call them, or national priorities. What are they? They are essentially, I want national security. That means I need a strong military. I need energy security, because if I don't have energy, then I don't really have an economy. So I need to secure that. I need to be able to access or produce my own food and all essential needs. That includes everything all the way up to semiconductors, rare earths, all these sorts of things. I don't want to be vulnerable on someone who has a less comfortable, friendly relationship with me in case at some point some of this abrasion that we're seeing all around bubbles up and becomes something more significant. We need to be able to produce this and put it in aeroplanes and missiles and things from home. And ultimately, there's this other thing that everyone calls AI, but it's robotics, it's automation, it's incredible technological transformation. And ultimately, if you are not at the frontier of that, if you are falling behind, your chance of making sure that you keep your place in the global order is diminished. So you must win this race. And everything that I just mentioned here requires an incredible amount of investment in infrastructure to ensure you don't fall behind. So what we now find ourselves in an environment where before central banks were dominating things, interest rates were all that mattered, keeping rates at zero, liquidity sorts of things, we now find ourselves in a government-sponsored world. That is, in other words, governments are essentially undertaking more programs for national interests. That's a fancy way of saying they are going to do much, much more fiscal policy.
Yeah, Brett didn't pull any punches there. I thought what he was saying was valid. It was almost like let's address what everyone's thinking. He's right. The US administration is it's an outlier based on history, but also this globalization that we've been living with for decades is now seeming to turn around. And what does that mean? So he was thinking big, but he was also kind of getting people to really think about the consequences of that. And if you think about it, particularly in America, what we're seeing with Trump, probably in a very abrupt fashion, is trying to say, well, I want to bring the manufacturing back to America. And some people think that's quite silly. He's not going to bring all the manufacturing back. But you can see that you do need to have, and COVID showed us that as well, I guess, that if you're not building some things at home, then everyone can't rely on factory China.
That's right. And I thought it was a good sort of opportunity to shine a bit of a spotlight on some of these risks that people aren't talking about and how that sort of manifests itself in the fixed income world, particularly with the heightened volatility we're seeing in yields and even how that over the last probably few years, we've seen the chase for yield. So we've come out of an environment for the last 20 years where almost zero interest rates and lots of liquidity through government stimulus and intervention, but this chase for yield that's been playing out and how that sort of now has grown through private credit. We've seen, huge proliferation of that, and just people sort of forgetting about some of the risks. And I still remember to this day, in a former sort of life, I was working for a wrap platform, and post GFC, when everything just hit the fan, we spent probably 2 to 3 years post 2008. It was really almost close to 4 years actually. In 2012, we're still talking to advisors who had clients in frozen funds. So 4 years really after the event. And those clients who are invested in those particular fixed income investments or any sort of credits investment that froze, like they didn't probably appreciate the risk that they were in. It's almost sleepwalking into it at the time. And it's just something I think, not saying history repeats, but it does rhyme. I think there's an opportunity to really sort of look closely under the bonnet at some of these investments and, potentially, are there risks that are sort of not being sort of addressed? There's some fantastic private credit and private equity managers out there, but Brett sort of really talked about making the point of looking under the bonnet and just making sure that there's no sort of hidden surprises in those investments. And I love the quote he said, liquidity, it's always there when no one wants it, but rarely there when everyone does.
So true. So true. So I thought he was great. That when there are 3 sessions that came out of Elston Elevate that were fantastic, but I think everybody really enjoyed it. It was a terrific conference. And of course, bringing everybody together, I think it is such a wonderful networking opportunity. Given that it's an Elston event, I can't imagine that it's all about being deadly serious. I mean, there must be some time to let your hair down. On the last day, was it the Friday? There's a bit of activity, wasn't there?
Yeah, we wanted to sort of mix it up and make sure that, particularly we had clients flying all over the world and all over Australia. The Thursday was pretty intense, so we packed a lot in from an investment perspective, but the Friday was an opportunity to sort of have a bit more of a leisure focus. So we had some groups who played golf. We had some who went fishing. I was fortunate to, being not a very good fisherman or not a very good golfer, I got to attend a cooking class, which was a Thai cooking class at Spirit House, which was a lot of fun. I think some people even did some spa treatments. And it was great to see a lot of the advisors stay on for the weekend and bring their families and the kids and partners and take advantage of a beautiful, beautiful spot, beautiful part of the world. So, yeah, it was really good and good feedback. And we're really keen to sort of make it bigger and better next year. So stay tuned.
Yeah, you might find it hard to beat that location, but I love the fact that it did roll into, some fishing, and some people did well on the golf course.
Yeah.
And I think everybody would be very keen to roll that into another long weekend next year. So you're going to have to work harder on your presenters, but also the location.
That's right. We've already started, so watch this space, Pete.
Well, thanks, Mark. Thanks for sharing your insights on Elston Elevate, and we look forward to seeing what happens next year.
Thanks for having me.
Cheers. That's all for this episode of FM Radio. I hope you can join us again soon as we tune into another aspect of funds management that affects you and your clients. FM Radio was recorded at Elston House. It was hosted by Peter Goodall and Mark Smith. For more FM Radio episodes and full transcripts of the interviews, visit elston.com.au. And if you'd like to subscribe to our podcast series to make sure you don't miss a thing, you'll find FM Radio on your favourite platforms, including Spotify and Apple Podcasts. The information provided in this podcast is general in nature. You must consider your own circumstances prior to making any investment. For more information, go to elston.com.au or speak to your financial advisor. Elston Asset Management is authorised by EP Financial Services, AFSL number 325252.